Hi, my name is Scott Shuttleworth and welcome to this week's Video Insight. Today we're going to perform a short analysis on ARB Corporation. Whilst this video is only to be considered as general advice, I'm hoping it'll provide you with some additional insights of analysis techniques that may be of use to you when considering an investment in a business listed on the Australian Stock Exchange. Let's start with a brief overview. ARB Corporation is Australia's leading supplier of four-wheel drive parts and accessories, which includes bull bars, canopies, roof racks, winches, just to name a few of their products. The business has built a very strong reputation and brand in the industry amongst enthusiasts by producing high-quality equipment. This translates into a competitive advantage that the firm has in the market. It has used its market positioning to put through price increases, which both protects and raises profit margins even in the face of competition. This competitive advantage has translated into revenue increasing from $115 million to $298 million over the past 9 years, a compounded annual growth rate of 11% a year. Net profit, one measure of a business profitability, has also increased from $14 million to $43 million over the same period, a 13% compounded annual growth rate. As we therefore show, not only is profitability driven by sales increases, the firm has reduced its costs as it produces more and gains scale. We also note their solid ROE track record above 20% in all years. This is a fantastic track record, but profitability in more recent years has been falling, most notably due to the tsunami in Thailand, which decreased the production of many automobile manufacturers, and looking forward into FY 13/14, we see the roll-off of capex from customers in the mining sector beginning to bite. Whilst this is a shorter-term headwind, ARB's consumer sales are ultimately linked to longer-term four-wheel drive sales, which have been rising steadily over the past decade. There are several factors which support this trend. Firstly, the expansion of choice in makes, models and years of four-wheel drives that automobile manufacturers produce, and secondly, the change in many consumer tastes from traditional sedans to larger four-wheel drives and other SUVs. What's most striking, however, when looking at the future prospects of the business is the US opportunity. The US has a population of 313 million, whereas Australia's population is about 23 million, and their national annual sales of cars is multiple than what our market has. The trick is execution. ARB's success so far in the US has been limited. However, it does appear that there is light on the horizon. ARB has new management in the US and it's already starting to show improving sales and profitability. To add to this, ARB is designing new bull bars catered for US consumers, and we expect ARB to launch its own network of branded stores, much like they have in Australia. I'll leave you with a few key questions to consider. 1. Does ARB have more potential for stores in Australia? Given that their success is proven here, more stores sounds like fertile ground for future profitability. Can margins be sustained in the future or even be improved? What forces would drive any changes? And thirdly, one of ARB's largest competitors, TMJ, is owned by a US-based institution. Do you think they have the potential to take market share from ARB Corporation? I'd love to hear your thoughts below on these questions, and I'll be adding some of my own thoughts to the blog in due course. Thanks for joining us this week. Until next time, you can follow us on Facebook or Twitter.